Governments and banks worldwide want you to stop using physical money and transition to making payments solely through the internet, using your bank's digital platform or mobile applications like PayPal. This money, which you don't have in your hands, is referred to as digital currency. Despite the growing popularity of digital payments, there are many dangers associated with using digital money that often go unmentioned. In this video, we will explore why governments and banks aim to eliminate physical cash, the risks of using digital money, and why continuing to use physical cash might be a good idea. It's common for people to think that physical money, that is, cash, is outdated. However, this perception may not be entirely accurate. The competition between traditional and modern forms of payment is not new, and history is full of cases where an innovation replaced a conventional product. For instance, when automobiles were introduced, they were advertised as a modern replacement for horse-drawn carriages. Similarly, digital payment companies portray physical cash as outdated and associate it with resistance to progress. This perspective is evident in advertisements by companies like PayPal and Visa, where digital money is presented as representing progress and chosen by the younger generation. However, the narrative that physical money is outdated and digital money is superior is misleading and potentially dangerous. In many large cities worldwide, there is a growing trend of rejecting cash payments, with businesses and individuals preferring digital transactions. This shift in behavior is driven by the perception that digital payments are more modern and convenient, yet this attempt to phase out physical cash could exclude millions of people from the global economy. Many individuals do not have bank accounts, either by choice or due to financial limitations, making them unattractive to banks. Additionally, a significant portion of the global population has never used the internet, preventing them from accessing digital money. Therefore, eliminating physical cash could potentially marginalize these individuals, leaving them with no means to participate in economic activities, such as making purchases or receiving payment for work. Considering the risks discussed earlier, it is challenging to imagine the existence of digital money without coexisting with physical cash. The money displayed in your bank account or mobile app would be meaningless if you couldn't convert it into physical cash. Despite these risks, many banks hope that people will gradually forget their right to withdraw physical cash, leading to the closure of ATMs and cost savings for the banks. In summary, the push towards a cashless society raises concerns about financial privacy, system vulnerabilities, and the potential exclusion of significant portions of the population from the economy. The first risk we face is the potential loss of our money if the bank closes due to a financial crisis. To understand this, consider digital money as casino chips. When we give money to the bank, it's like buying chips at a casino. The bank provides us with digital money in exchange for our physical money. If the casino runs out of money while we're playing, our chips become worthless. Similarly, with digital money, even if we see a certain amount in our digital wallet, it's meaningless if the bank fails. In the United States, the Federal Deposit Insurance Corporation, FDIC, insures bank deposits. However, this insurance has limits, covering up to $250,000. If you have more money in the bank, you would lose the excess amount. Furthermore, not all banks or mobile payment apps are insured by the FDIC. The second risk involves system failures that could prevent us from accessing our money. A digital bank account relies on accessibility and the continuous functioning of its system. If we lack an internet connection or the system fails, we lose access to our money. Physical cash, unlike digital money, does not become inaccessible during power outages or cyber attacks. In 2018, Visa experienced a system issue that interrupted services across half of Europe for 10 hours, blocking 5.2 million payment attempts. If digital money were the only option, such an interruption could have halted a significant portion of the European economy. The third and perhaps most critical risk relates to privacy. Making payments through digital means allows banks, companies, and governments to track every transaction we make. Banks benefit significantly from this shift to digital payments as they gather extensive data about individuals. This information is valuable for identifying consumer preferences, spending habits, income, and more. By selling customer spending data to companies like Google or Facebook, banks capitalize on this valuable resource. Consequently, transitioning solely to digital money would expose individuals to heightened surveillance and compromise their financial privacy. Given these three risks, it's challenging to envision the coexistence of digital money without the availability of physical cash. The narrative that physical money is outdated and digital money is superior oversimplifies the complexities and risks associated with a cashless society. As the transition towards a cashless world unfolds, concerns about financial privacy, system vulnerabilities, and the potential exclusion of significant portions of the population from the economy should not be overlooked. For example, if you bought a tennis racket with your card and the bank sells that data to Google, then Google could start showing you ads for tennis shoes, tennis lessons, or sportswear. The fourth risk is related to how our brains function concerning digital money. When you spend money, having physical cash allows you to see exactly how much you have and how it's being spent, making you more conscious of your expenses. However, with digital money, the brain reacts differently. An article from the Wall Street Journal states that when using digital money, people not only tend to spend more because they are less aware of the money disappearing, but our brains encourage consumption. In other words, it compels us to buy. Therefore, when using digital money, there's a higher risk of spending on unnecessary items or even spending money we don't have, especially with credit cards. The last significant risk to discuss is related to governments, especially in countries with authoritarian regimes. One major concern about the rise of digital payments in such countries is that the government can instruct banks to prevent people from withdrawing their money or even restrict what they can spend their money on. For example, a government could prohibit banks from giving money to individuals who oppose the government during protests. During the 2019 Hong Kong protests, activists stood in long lines to buy metro passes with cash to avoid being tracked through digital means. If digital money had been prevalent, the government could not only have identified the protesters, but also blocked their cards to prevent them from participating in the protests. The problem extends beyond surveillance. Digital money allows the government to control how you spend your money and even limit your expenditures. An example is the Australian Cashless welfare card, a credit card issued by the Australian government to low-income individuals. This card restricts users from withdrawing cash or making purchases of alcohol, gambling, or other expenditures not approved by the government. Considering these risks, it's crucial to advocate for the continued use of physical cash to prevent exclusion from the global economy and safeguard privacy. Those in favor of a cashless society argue that physical money is an outdated obstacle, similar to horse-drawn carriages blocking the road for cars. However, there's no conflict in maintaining both cash and digital systems concurrently. Unlike horse-drawn carriages hindering cars, physical cash and digital payments run on separate tracks without interference. Digital payments may facilitate rapid and global transactions, but physical cash remains inclusive, universally accessible, and useful in specific situations, such as small transactions, informal gatherings, or donations. It's a parallel system that ensures financial inclusivity for all and provides a viable alternative when digital systems face challenges. Analyzing the success of the digitization of money, it's evident that the trend toward reducing ATMs is more pronounced in wealthier countries. This trend may result in a world divided into two parts, where billions of users who continue to rely on physical cash find themselves excluded when traveling to more developed nations that predominantly use digital systems. Hence, it's essential to maintain physical cash to prevent anyone from being excluded from the global economy. So far, we've discussed banks and companies trying to persuade individuals to abandon physical money. However, governments are taking it a step further. Just a few days ago, the European Central Bank, responsible for printing euros, began discussing the creation of a digital euro. A digital euro would be money created directly on an internet-based network, exclusively existing in digital form. This news sparked criticism from Europeans, and even Christine Lagarde, the president of the European Central Bank, acknowledged that 43% of Europeans are primarily concerned about privacy. However, Lagarde's response to these concerns was worrying. She stated that complete anonymity, similar to what cash offers, is not a viable option. Essentially, Lagarde is admitting that the transition to digital money would entail some degree of privacy loss. She added that the idea of anonymity would contradict other public policy goals, essentially acknowledging that the state wants to monitor and know everything about individuals. While she later tried to reassure by stating that the European Central Bank is seeking a balanced approach between privacy and preventing illicit activities, the acceptance that the government wants to surveil individuals is troubling. Europe is not the only region considering a digital currency. The United States Federal Reserve, responsible for printing dollars, has already launched a pilot program for a digital dollar. The Bank of Japan is also considering digital currency trials in 2023, and China has already introduced its own digital currency during the Winter Olympics. Major world powers are contemplating launching their digital currencies with the aim of gradually phasing out physical cash. Advertisements from digital payment companies emphasize the speed and convenience, but remain silent on privacy loss, cyber threats, exclusion of individuals unable to use digital money, and technical issues these companies might encounter. Governments are pushing for the launch of their digital currencies to gain control over every aspect of individuals' financial activities, deciding what they can and cannot spend their money on. Thanks for watching, guys. I hope you enjoyed the video. Please leave a comment. Also, please consider liking and subscribing. I would really appreciate it. Thanks.